this conversation, we are trying to dissect what happened in quarter two in terms of earnings for the market at large and for individual pockets as well. And in that quest, as is the norm, we talk to Gautam Duggad of Motilal Oswal, and he joins us right now on the show. Gautam, good having you. Thanks for joining, and hope all is well.
All good, Neeraj. Thanks for having me.
Was all well for India Inc. in quarter two?
Yes, it does seem so, but when you look at numbers and aggregate, there are always a lot of nuances which sometimes aggregates tend to gloss over. So, if somebody comes in and just looks at the aggregate, he or she might feel that numbers were fine because on aggregates, the expectations were met or rather slightly beaten, you know. But when you look at the internals, they are slightly weaker, especially when you look at numbers excluding Nifty companies. So I'll just give you some headline numbers. When you look at our coverage universe of 223 companies, we were expecting actually, when we did the preview, a decline of 16% in profits. The actual number is 5% decline, so it's better than estimate. For Nifty, we were expecting no growth, but the actual performance is at about 9% growth. So what has actually happened is financials have outperformed expectations big time. And at the same time, the losses that we were building in OMC, they have materially undershot because government has given them some 22,000 crores of subsidy to make good for the losses in LPG. So all of that got accounted for in this quarter, and hence the big OMC losses that we were expecting at about 28,000 crores, the actual losses were much lower, right, at about 10,000 crores. So that has provided some optical boost to the aggregate numbers for our broader coverage universe. Secondly, if you are to look at just the domestic facing sectors, basically we exclude metals and oil and gas in it because we were expecting a huge drag from global commodities. So if I look at my aggregate numbers by excluding global commodities, which is metals and oil and gas, profit growth is somewhere about 30% for my coverage and 33% for Nifty. Again, in line. So this is the positive side of the story. If I were to flip it and look at numbers by only excluding financials, then there is a problem. If I look at numbers excluding financials, my aggregate universe is down 22%, which, by the way, we were expecting it to be down 34%. And Nifty earnings are down about 3%. So, whichever way you slice and dice the numbers are better than expectations, just that the spread of the numbers is slightly weak. As far as forward estimate revision goes, about 67 companies in our coverage universe has seen a earnings upgrade of more than 3% for FY23. 92 companies have seen a downgrade of more than 3% for FY23. So sequentially, the upgrade to downgrade ratio has weakened, right? As far as the current quarter is concerned, around 72% of our coverage universe has beaten or met expectations on earnings. Roughly 28% of the coverage universe has disappointed. So that is the broad picture. And the last point being, when I just do a very sort of top-down calculation by taking out the Nifty coverage earnings from my MOSL coverage earnings, then the picture is slightly weaker. And even if you account for the drag from global commodities, sector by sector, non-Nifty companies have shown more pain on both margin as well as the forward earning revision front. So that's how we concluded the quarter. End of the day, our Nifty earnings have got upgraded by about 2.5% for FY23. So now we are expecting an EPS of 837 rupees, which is a growth of 14% for FY23.
So size matters, Gautam. Is that the inference?
Yes, definitely. More so in an environment where the pressure on margins is quite high, because while the commodity prices have corrected from June to now, the quarter that we are talking about, September, the consuming inventory was a inventory which was procured 3-4 months back. So the benefit of correction in commodity cost was hardly there. You will see it in third quarter and fourth quarter. But as far as second quarter is concerned, we have seen about 200 basis point of a margin decline ex commodities. And if you don't explode commodities, then the margin decline is about 500 basis point. So yes, you're right. The size does matter.
Okay. Gautam, I was wondering if we can do the conversation in a way that we talk about some of the key some of the key result disappointments or result beneficiaries, but also attach an angle of whether you believe there could be a bounce back or a fall down from where they were at the end of quarter two, right? So I was looking at your note and the disappointments thereof and obvious disappointments. Um, let's avoid metals for the time being. We'll come back if there is time because they had a bad quarter, very little to say that they might have a really good quarter. So let's park that. The other pocket which had a bad quarter was cement. You
Yeah.
aptly highlighted that might not be a global cyclical and might not be a very large heavyweight, but had a terrible quarter too. What's the sense about what do quarter three and quarter four hold in store?
So Neeraj, we actually believed since June that September quarter will be the worst for cement.
Okay.
And if you look at the numbers now, EBITDA per ton is at a 48 quarter low. Our view is that this is a bottom quarter as far as margins is concerned. From here on, you will see some improvement sequentially in margins because the lower cost of fuel and other consumables will start reflecting in their P&L. But at the same time, some of the costs have again moved up in the last 40 days. So that will start pinching you again in fourth quarter. So while it's a very chaotic scene when you look at numbers quarter to quarter, but yeah, in the short term, when you look at sectors like cement, you do feel that third quarter will be better than second quarter for sure. Because second quarter, virtually, you're standing at a 4-year low EBITDA per ton for the pure cement companies, and the numbers were, quite weak. 70% profit decline for the cement coverage. I don't remember when we saw this kind of a decline there. But that being said, we were expecting this kind of numbers right from the beginning of the June.
Mm. What about sequentially or in the second half, the kind of beliefs around construction activity or infra activity? Can that help spur some of the top line numbers for the cement names?
So top line was fine, Neeraj, even in this quarter. If you look at the
Sure.
top line for cement companies this quarter, we have seen a 9% volume growth for the coverage and about 5% realization growth. So you have seen a 14% sort of a sales growth for cement coverage. The problem was on the margin front, where, you saw 40% EBITDA decline and 70% profit decline. To come to your second point, yes, housing, real estate, infrastructure, these are some of the essential components which does give us confidence that the demand for cement will remain decent going forward as well. And if at all you see corporate capex recovering, then obviously it will add its own extra delta to the cement year-on-year volume growth as we move forward in the second half of FY23. But the top line growth was decent even in this quarter.
Got it. And therefore, the variable is the operational metrics, and that the sector is not out of the woods as yet, maybe post quarter four, if at all.
Yes. Yeah.
Okay. The other one, which maybe I didn't read too much about, but I would love to understand from you. Anecdotally, when I looked at the numbers and when I spoke to a few companies who talk in the spec chem space, there was clearly pressure out there. Now, again, a very wide universe, maybe not be heavyweight from the index perspective, but widely held as well. What are your thoughts there on spec chem? Was Q2 the amongst the worst of the quarters, or is that sector also not out of the pain as yet?
So, Neeraj, when I look at the spec chem sector, numbers don't look that bad. To begin with, we were expecting a 20-21% profit growth. The actual growth is 18%. Okay. Similarly, on EBITDA front, we were expecting a 20% growth. The actual performance is 17% growth. And actually, top line, there is a big beat. We were expecting 20% top line growth. There is a 30% top line growth.
For your universe?
For my universe of specialty chemical companies. And of course, you saw reaction of names like PI and all after the results. So while there is definitely a pressure which is evident, but it is well accounted for. In fact, I am seeing this not just this quarter, but even for the last 2-3 quarters, if you see the performance of specialty chemical companies, I've been watching that there have been upgrades and there have been beats in specialty chemicals for third quarter in a row now. For the 9-10 companies that we cover, there are only 3 companies which have missed our expectations. Rest is either in line or a big beat. Names like Fine Organic, names like Galaxy, they've all beaten our expectations. right? The problem, however, Neeraj, the right thing to look at this sector is right now valuations are too frothy, even though the sector might not have done much in the last 6 months. But the entry valuations, if you look at numbers a year back or 9 months back, were so expensive that despite the growth that we are seeing for the last 3 quarters, the valuations are still not giving you comfort. So the problem of this sector is not narrative or numbers, it's more on valuations.
Okay. Okay. Yeah. So actually, some of the maybe not spec chem, but some of the chemical companies had a slightly tough quarter as well,
Yeah.
and that kind of marred the performance. But point well taken, Gautam. It's interesting to note that if sector has performed for 3 quarters in a row on the fundamental side, and yet it's looking expensive, just gives you a sense of how expensive it actually was some time back.
To begin with, yes.
Got it. Okay. Now, again, I leave out oil and gas, Gautam, fairly unpredictable and, per se, a lot of government intervention which may determine. So I want to try and talk about the positives, if you will. Then, of course, if I missed out something, we'll talk about it in the end. The positives, everybody's bullish on BFSI and it is performing. I mean, the numbers were rock solid for most banks. Tell us what stood out for you.
So, Neeraj, as I keep repeating every time when we discuss, financials have been extremely consistent, and this is fifth year in a row now. And this quarter was no different. There was a 50% growth in financials profit. Within that, private bank about 60% profit growth. PSU bank, we were expecting a 25% profit growth. You got 53% profit. A heavyweight like SBI, where expectation that we had was 10,000 crores, the actual number was 13,000 crores. So clearly, the momentum on loan growth plus margins plus asset quality, all of this is basically amplifying the effect that you're seeing on the bottom line for the sector. And we have just seen 1 or 2 months of 15-16% credit growth. If the credit growth continues to improve, right, at some point of time, there will be margin pressure, which is given because the deposit growth is lacking the systemic loan growth. But even then, if credit growth remains strong, larger banks, because larger banks are what drives the profit pool in financials, then they can continue to deliver good growth, even if the asset quality now is in the base. The improvement in asset quality is a 4-year phenomenon now. If you look at FY18, the profit of financial companies in BFSI was 45,000 crores. And in FY22, we ended with 1.5 lakh crores. FY23, our expectation is 2,06,000 crores. And this number has gotten upgraded in this quarter by 3%. One of the few sectors where earnings have seen a genuine upgrade, right? So financials has been leading the earnings growth significantly. And I think FY23 also is no different. In fact, if you keep aside the quarter for a moment and look at the full year number on FY23 for Nifty, then financials alone are driving 60% of the incremental growth in earnings for Nifty this year. So if your Nifty earnings are growing at 14%, 8.5% contribution is coming only from financials. That is how strong the sector is. At some point of time, definitely next quarter or a quarter after that, you will find some pressure on margins because the banks will have to, scurry around for deposits, and therefore the cost of deposits can go up for them.
Got it. And interestingly though, despite all of this, Gautam, when I see your top ideas list, it has got one SBI, 2 other large private banks, and 1 mid-sized bank. That's it. So there is SBI, I think there is ICICI, IndusInd, and IDFC First, right?
Yeah. So Neeraj, if you look at it, out of 10 or 12 or top ideas, there are 3 to 4 banks, right? Now the index.
Broader end, you don't have too many.
Yeah. So basically, the right way to look at it is if you look at my model portfolio composition, we have about 300 basis point overweight on financials. We have allocation of 37% to financials. When we did the model portfolio revision a month back versus the index weight, which we use as a benchmark BSE 100, which then had the financials weight of 34.5%. But the bigger differentiating factor for us as far as financials is concerned in our model portfolio is the fact that we have a significant overweight on PSU banks. So I have 450 bips overweight on PSU banks. Private banks is sort of neutralish now, and NBFCs we are underweight. So that is how we reach that 300 basis point overweight aggregate for financials. So we have SBI, we have Bob in the model portfolio, and then the usual staples like ICICI Bank, HDFC Bank, IndusInd Bank, they're all there. But the delta is coming from PSU banks. Something like a BOB, which we had added 9 months back at a price of 85 or 90, has done exceedingly well. And the quarter has been also strong, where we have seen an earnings upgrade of double digits.
That's true. That's true. Okay. Okay. So there is a spattering of PSU banks as well, and they've been. I mean, October has been, or at least was, a blowout month for some of these PSU banks, and then the momentum continues out there. Okay. So that's as far as financials go. Gautam, what about autos? Again, the bases may have come into play. Um, Mixed bag of sorts. In most cases, I thought there was a bit of a positive surprise, save for an Escort, which kind of disappointed, or one or two other names. Tata Motors was a bit of a disappointment, or actually quite a bit of a disappointment. CEO has resigned. What did you make of autos?
No, so auto, I always look at excluding Tata Motors, given the
Okay.
unpredictability associated with Tata Motors. So if you look at auto numbers excluding Tata Motors, they've been bang in line.
Hmm.
There is a low base, and on that low base, they've more than doubled the earnings. So Maruti was a beat, Mahindra was a beat. You've seen beat from Motherson also.
Yes.
So net, the auto as a sector, when you look at the sector in totality for the quarter, earnings have beaten, or rather, earnings have met the expectations, which were high on a low base. To come to your point on Tata Motors, it's very difficult to look at this company on a quarterly basis because there are so many moving parts on multiple line items of the P&L. So it's virtually difficult to forecast quarterly earnings. And you've seen over the last 4 or 5 years, very rarely you get the numbers right on a quarterly basis for names like Tata Motors. But yes, there are problems globally, which are quite self-evident on demand because there is a recession we are talking about in US and Europe. And to compound their worries, there is an issue on semiconductor supply chain. And to add to the problem, the debt is not going down. 60,000 crores of debt is not a small number, right? And whatever guidances they've given, they keep, given the kind of volatile environment that we are living in, those guidances change every quarter, whether it is on free cash flow or on leverage. So that is, one name where it is very difficult to make any sort of guesses. But domestic facing auto companies are doing quite well. Demand is strong, both on four-wheeler and also on two-wheeler, which is showing some incipient signs of recovery after almost a lost decade, right? Uh, Commodity costs have corrected. You have seen pressure on supply chain easing, and the festive season has gone off well for them. So we are quite positive on auto, but more on domestic facing names like Maruti, M&M. And then on the two-wheeler side, our preference is Eicher. But the real action happens in auto when the cycle picks up, then action happens in the non-traditional sort of auto names, which is auto angs, and names like Motherson Wiring that we've been very positive on, Tube Investment, where we've seen a tremendous 60-70% run up in the last 6 months since we initiated. Those are the names which tend to provide better alpha in the portfolio rather than the traditional 5-6 nifty names,
Hmm.
which are part of the nifty basket.
But interestingly, I heard fairly diverse commentary, Gautam, in that Escorts did what it did, Mahindra and Mahindra did what it did, and we there is a small company, smaller relative to them, a VST Tillers coming out and saying that they will grow at some 30-35% for the next 3-4-5 years CAGR. Motherson Sumi versus Bharat Forge, and I know different segments, but just a complete chalk and cheese performance. How do you dissect that?
No, see, in auto, generally the usual fallacy we do is that we try and extrapolate the commentary of one segment to other. It's like, to an extent, if I might be exaggerating, but it's like pharma, where no two companies are similar. In auto, you have four different segments.
Sure.
Tractor outlook is very different today than the passenger vehicle segment.
But within
CV is in a
tractors
good.
also, it was slightly different.
Yeah, but then because there are multiple other elements which come into play, the base, the kind of new launches that you are having, the geographical exposure. So something like M&M will obviously have a very different sort of outlook to give, given that they are present across India, and they've done exceedingly well on tractor also for the last 3 years. So base is quite high. In fact, I believe that the tractor outlook that they've shared is slightly conservative, and they might overshoot their own guidance on tractor. You already seen their SUV guidance on production. They are scaling up on a month-on-month basis or quarter-on-quarter basis. The product cycle is quite strong for them, and they will also be beneficiaries of the moderation in commodity prices in the second half. And when your volumes are so strong, given that it's a cyclical sector, the operating leverage comes into play very strongly. The sore point in auto right now is two-wheeler, the traditional companies, where the volume doesn't seem to be making any headway. And that is also a reflection of, I would think, a weaker disposable income growth. And at the same time, the elevated stress that we are seeing in rural consumption for last year and a half, which is what some of the traditional consumer stable companies also alluded to during this quarter's earnings call. Auto obviously has a very strong exposure in rural. So if rural tends to do weak, then you see the impact clearly being felt by two-wheeler auto companies.
Got it. Since you track consumers so closely, I'm going to club a few companies which are not necessarily in the same space, but you could argue that you could call them building materials or connect in that space. And all of them either have a paints or an adhesives or some other business, right? But the question that I had for you is that we have an Asian Paints which has announced a large capex. Presumably, they see growth there. Versus we have a Pidilite who says, hey, we are done with our capex for the last 2, 3, 4 years and we are going to milk it. As also an Astral which says that we are done with our capex. Some more capex might happen, but they have this angle of PVC prices which are still lower, etc. But where all of these are highly priced consumer names with a building material angle, but slightly different stories about capex attached to them. How do you look at them?
So, I mean, see, Asian Paint has always been cut above the rest when it comes to capex because every 3 years they take a big capex program and expand their capacities. And if you see the performance for the last 10, 15 years, the volume growth has sort of justified the kind of capex they've done. And given the elevated competitive intensity that we are seeing in paint sector now, where the new players are entering in with big muscle and big pockets, it's quite natural for somebody who has been dominating the industry with a 60% market share for more than a decade, 2 decades, 3 decades now, to sort of protect its stuff and invest ahead of the curve and build capacities, which sends out the message to not just the competition, but also to the supply chain and ecosystem that we are here to stay. And it is also a reflection of the fact that paint industry, if you see the industry volume numbers, traditionally it has tracked at about 1.5 to 2 times the nominal GDP growth when it comes to industry volume growth, give or take 1-2% here or there. So the outlook for the industry is quite strong, especially on the paints and adhesives both. The problem, as always, Neeraj, for some of these companies is valuation. If you're pricing the stock at 80 times, 90 times, and growth falters by even 5-10 percentage points, then you suffer extended period of time correction, which is what we are seeing in Asian Paint now. Price has not gone anywhere for the last 1.5 years now, somewhere about 3,000 if I'm not mistaken. But even then, their 5-year CAGR is in mid-20s, which is not bad, right? So the entry point of valuations in some of these companies, generally sort of assumes that the growth is linear and growth will not disappoint even for a quarter, because if it does disappoint for a quarter, the reaction is very different.
Compare that to companies like Pidilite or Astral, which are, again, different, but I'm just saying still the building material space and have done the capex and might benefit from there. What's your sense?
Yeah, I mean, see, these are some of the most well-managed, high-quality companies, especially Pidilite. If you look at Pidilite's history, I, for example, do not find it easy to recall a second or a third brand in its segment. At least in paints, there is an oligopoly. There are 5-6 players which are there now. If someone were to ask me to name a competitor to Fevicol, I'd have to scratch my head. Right? Astral is a new entrant and relatively very small in comparison. So that tells you the kind of job that they've done over the last 3-4 decades in building that brand. It's one of the few, I don't even recall any other country where paints and adhesives are treated like a branded consumer goods. It's only in India that they get the stature of a branded consumer good. Everywhere else, it is traded, it's considered as an industrial category. Second, the sheer fact that the real estate build out in India over the last 5, 6 years had suffered. 2010 to 2000, I would say, the 1920 real estate cycle started just about 6, 9 months back, right? Despite that, the volume growth performances of some of these names has been quite healthy. I agree that the growth has been quite low on bottom line for the kind of valuations that they attract. All said and done, Pidilite trades at 70 PE or maybe 67, but the trailing 5-year profit CAGR is just about 10 to 12%. And the number is no different for Asian Paint either. Whether you look at the profit, free cash flow, whichever number, the trailing 5 years growth does not justify the kind of premium valuations at which they are trading. So at some point of time, either the growth has to pick up or the valuations have to go down. This equation cannot sustain beyond a point. Right.
Got it. Okay. My final question, Gautam, because they can go on really, it's a wide market out there, but there's paucity of time as well. My final question is on IT, because it came out with what is arguably a very chalk and cheese quarter. If there was anything which was chalk and cheese in India in this time around, it was large cap IT or mid cap IT. You pick and choose. One company did well, the other did not. Commentaries are also, you would have to admit, diverse in terms of the longevity of confidence that they have. Um, how are you reading into it? Because I know you are not underweight on IT, but how have you read into the performances and the commentary, and therefore where is it that you believe winners will emerge within IT?
So we like the sector. We've had a highest overweight on IT in 2020, 2021. This year also we had one of the highest overweight at the beginning of the year. We moderated that, but still overweight on IT. The only distinction I want to make is we are completely allocated towards large cap and not in mid cap, because I find it difficult to justify 20, 30, 40% premium to TCS Infosys to some of this mid cap IT, even though they're growing faster. The problem in mid cap IT is, if you see the pattern of last 15, 20 years, every 2, 3 years, they trade at a premium to large cap IT, and then the sort of justification that is being given is, but they are growing at a faster rate. But then after 2, 3 years, they slip into the discount, and that time the justification is their client concentration risk is higher, their pricing power is limited, there is vendor consolidation which is happening. So you have to be very, very cautious on the sort of entry valuations that you're paying in mid cap IT. As far as this quarter is concerned, numbers were in line. So we were expecting 7-8% profit growth. That is what we got. There was no red herring on margin. There's no red herring on the demand commentary per se. There are obviously some pockets where few companies came and called out that there can be some caution which can come in. Some clients are getting cautious while forming their budgets for the next year. But I don't recall a single IT company downgrading their guidance. While the talk of US recession has been in the work for last 6, 9 months. In fact, on the contrary, we have seen guidance upgrade by HCL Tech and Infosys. So maybe at some point of time, the US recession may play out, and maybe 6 months down the line, IT companies come and downgrade their guidance. But as of now, they have not done. Neither is it reflected in their commentary for the foreseeable future. Valuations have corrected 25-30% from the last 12 months, if you look at a trailing 12-month basis. The reason why we like IT is the consistency in cash flows. Now, I believe that in India, there are only two defensive sectors, consumer and IT. I don't think pharma is a defensive sector because no two quarters are predictable for pharma companies. Their payout ratios are low. Their ROEs are also low. And their leverage is much, much higher than a typical consumer or an IT company. Whereas on IT side, if you see, last 7 years between FY15 to 22, I'm deliberately keeping FY23 aside because the year is not over yet. FY15 to 22, the top 5 tier 1 IT companies put together made a cumulative profit of 5 trillion rupees. Okay. Out of which they have returned 3.8 trillion back to the shareholders, which is a humongous 76% payout on a 7-year basis cumulative for 5 IT companies put together. I am of the view that IT companies deserve to trade at a higher P than they used to command pre-COVID, because the 3 important matrices which decide a P ratio, one is growth, obviously, second is the quality of balance sheet and cash flow, and payout ratios. On all 3 matrices, IT companies are as strong, if not stronger, than consumer companies. The only difference is they are global in nature, and therefore market will obviously tend to value them at a discount to a typical consumer company. So we find IT valuations quite okay. In between, there will be quarters when there will be heightened concerns around what is happening globally. But I think that is the time to get into this sector. But
Okay.
all said and done, our preference is towards large cap.
Got it. There are 5 names out there, or 6 now.
The five,
Which
okay, yeah, now there will be six. Yeah.
you prefer the Infosys and the TCSs of the world?
Our top idea is Infi, TCS, and SCL Tech. And these are the three names which we have in our model portfolio.
Yeah, but there's a diversity in the valuations. HCL is much cheaper,
Absolutely.
way cheaper than Infi and TCS.
But Neeraj, you know, in India, typically, very rarely you will find valuation narrowing story play out. Sector
That's true.
after sector, one keeps talking about X is trading at a 20% discount.
Yeah.
At some point of time, it will narrow. It doesn't happen. Very rarely it happens. The market is very smart in ascribing whatever valuations it ascribes to a respective company across sector.
That's true. It's just happened very recently in banking, or starting to happen after many decades of
Yeah,
HDFC Bank ruling the roost. So in that sense, it's interesting. But Gautam, lovely talking to you as always. Thank you so much for taking the time out today as well. And
thank you.
we'll of course talk to you after the next quarter as well.
Thank you, Neeraj. Thank you.
Thank you, and viewers, thanks for tuning in.